Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 40. Mr. Nirmal Kumar has categorized all the available stock in the market into the following types: small cap growth stocks, small cap value stocks, large cap growth stocks, and large cap value stocks. Mr. Nirmal Kumar also estimated the weights of the above categories of stocks in the market index. Further, the sensitivity of returns on these categories of stocks to the three important factors as estimated to be. If factors are involved, then it will be APT, arbitrage pricing theory. Okay. Now the category is given, then weight of the market index is given, which is nothing but the weight of our portfolio also. And the factors are given: factor 1, factor 2, and factor 3. Here factor 1 is beta, but actually whatever values they have given here, so this all are beta only. I'll explain why. In the first case, it directly says beta, which in turn means the sensitivity of this one of these stocks towards the market return. So that's what this beta signifies. And the second one is the sensitivity of these stocks towards the book price, and the third one is the sensitivity of these stocks towards the inflation. So altogether this all are betas only. This is beta 1, and this is beta 2, and this is beta 3. And in as per APT model, we'll be calculating the expected return, which is nothing but risk free return plus the risk premium. In our case, risk premium will be lambda 1 multiplied by beta 1, which is nothing but the factor 1 multiplied by the sensitivity, factor 2 multiplied by the sensitivity, and then factor 3 multiplied by the sensitivity. So factor 1, factor 2, factor 3 we know, and the percentage change also we know for calculating the um, risk premium and multiplying with the betas. So in individual returns, small cap and large cap growth, we have found out the basically the first requirement is also about that only. Using arbitrage pricing model, pricing theory model, determine the expected return on the market. So the determine the expected return on the market index. So this is what we have, that's the market index, which will be considered as the portfolio. So we need anyway portfolios expected return, right? Okay. For that we can directly take, we will be calculating the APT expected return for individual stocks, then we will be multiplying with this weights to get the expected return on market index. Okay, individually we'll be finding out with, since they have given risk-free return as 4.5 percentage, so risk-free return will be taken care here, and then so in all this case risk-free return is same, then the risk premium, so that we will get by the beta. As I told, this will be the betas, this all will be the betas multiplied by the risk premium, will give us the expected return. So as we can see, small cap growth has 5.9925 percentage, and for small cap value it is 8.8525, and for large cap growth it is 8.478, and for large cap value it is 7.535. Multiplying these returns with the probabilities will give us the expected return, which is nothing but 7.7526 in our case. Then the second requirement is using CAPM, determine the expected return on the market index. Now as we know, CAPM will consider only for the beta, which is the sensitivity towards market index. So we have to consider only factor 1 and not the other factors. So considering only the first factor, we will get 9.98, 10.665, 12.48, and 10.3225. For multiplying these returns with the probabilities, which is weight in the market return, will give us the expected return on market index based on CAPM model, which is nothing but 11.33 in our case. Now the third requirement is Mr. Nirmal Kumar wants to construct a portfolio consisting only the small cap value and the large cap growth stocks. If the target beta for the desired portfolio is 1, determine the composition of his portfolio. Now, in the since in our previous problems, how we will find out the portfolios beta by weighted beta of the individual stocks, right? Now, as we know, only small cap value and large cap values are involved. So whatever the betas are there for the small cap and large cap, what is that, large cap growth, small cap value and large cap growth, which is nothing but zero point 0.9 and 1.165 multiplying with the weight will give us the total portfolios beta, and they told that to keep the target beta as 1. So 0.9 multiplied by weight of small cap growth, which is x1, plus 1.165 multiplied by x2 should be equal to 1, which is nothing but the portfolio beta. Now, since only two stocks are involved, x2 will be nothing but 1 minus x1, right? So substituting that, we can arrive at this value of 0.623 for x1 and then 0.377 for x2. So that will be the weights of small cap value and large cap growth for this portfolio of target beta having 1. Thank you.